Hello Propenomix people, and welcome to the Sunday supplement from the 19th of May 2024. As you know, I like to start these off with a quote, and this week's was: "The idea that the future is unpredictable is undermined every day by the ease with which the past is explained." And that's from Daniel Kahneman, who sadly recently passed, the father of behavioural economics. And if you haven't read Thinking Fast and Slow by Kahneman, it is an absolute classic that you should fit into your reading or Audible or whatever reading lists, because it's a super piece of work. And I called this week The Bank Uncovered, because what I'm going to talk about when we get to the meaty section is the Bank of England and the monetary policy report, and try and explain a bit more about it, because I went this past week to the Bank of England breakfast briefing meeting in Coventry over at Warwick Business School, and it's a great thing because I get a chance to ask the reps some questions, see what the temperature is in the room as well, what people are understanding, what they're not understanding, how they're feeling, how local business people are generally doing, what the demeanour's like. You can imagine it's been pretty miserable the last couple of years. It's picked up a little bit now, but really you've got a bunch of a section in the room who are baying for a cut and can't really understand why there's not going to be a cut when we're being told that inflation this week is going to print 2% or so. And also, the bank's model shows 1.6% inflation within 3 years, which you would think does leave room for a cut. But anyway, before I get into all of that, I just want to highlight there are only 2 super early bird tickets left in the upcoming property business workshop that I'm running with Rod Turner. This time we'll be taking on the fundamentals of property investment, risk mitigation and control, relevant investment metrics, differing secured debt arrangements and loan structures, and scaling your property portfolio or business. Why, when and how. That's going to be on Thursday the 4th of July in a central London location. The super early bird tickets have 20% off, and just want to say I'm really grateful for the early bookers who make it viable for us to book a room and organise the event for real. That's why they're rewarded with that 20% off. Those 2 tickets are going to be sold in the next couple of days, I'm sure. So if you do want one at the lowest possible price, please get on with it and go to the link bit.ly/PBWTHREE. So, thanks for listening to that one. I love this bit of the week each quarter because I get to go to that Bank of England regional breakfast, and without trying to, I do tend to make a nuisance of myself. I'm often surprised as well about what a very educated, active, plugged-in room doesn't understand about the current macro situation, which plays out by the questions that get asked. And last week was no different. As I said, I had a couple of questions of my own, and I will share the outcomes of those with you all. But we've got to get through the macro bits before we get on to the real meat of this supplement. So you know that we're going to be talking about the 5-year gilt and swap yields, because we have to do that every week. But I think we need to get stuck into the ONS labour market report and unemployment in general. You'll know that I tend to prefer to focus on employment and some of the other metrics around that, but we have to talk about unemployment because it is the one that moves the needle the most apart from anything else. And we have got to remember the ONS have still got various problems with their surveys. The Bank of England rep actually referred to it and said basically COVID drove a coach and horses through the way the ONS collect their labour market data, and they just haven't recovered from that yet. So there's a lot of uncertainty about what the true employment figures are at the moment. They've got some new methodology coming forward in September, I'm afraid, so we've still got 4 months to go until we get that, but there we go. And I need to talk as well about productivity, and I just want to also say a little bit about what the main players at the Bank of England have been saying this week in a bit more detail than usual, because they've been particularly active with their speeches. You'd be forgiven for being bloody confused, because there are headlines about cuts, raises, holds, cuts soon, cuts not soon, and everything in between. So I want to try and get to the bottom of that or somewhere near it before I get into the relevant parts of the report. As you know, though, for the last few weeks I've been including a bit of a bonus before the macro, the amuse-bouche, if you like. As I said last week, I want to make more of a feature of this. The stats from Property Stato Christopher Watkin, who is, in my opinion, the best provider of real-time residential property stats in the game. No blockbuster headline this week because bank holidays always chip the stats a little, of course, which are going back to the week which had the bank holiday in. But net sales were up 11.7% on the equivalent week in 2023, and gross sales are up 7.7% on the 2017 to 19 average. And they're up 8.2% on last year. And the reason why that's important, well, the pre-pandemic market is seen as a much calmer, and of course it was, much more stable property market. So how are we doing in comparison to those 3 years? Well, gross sales are up. Gross sales are before we consider fall-throughs. but fall throughs at the moment are running at just over 1 in 5, about 22%. So about 2 in 9 deals have been falling through. There's been points over the last few years where it's been 50% post-Liz Truss, for example, and certainly 40% in certain quarters where there's been difficult interest rate movements apart from anything else. People have been, of course, some people think, well, prices are going to go down, so I'll pull out and I'll wait. Usually a big mistake. If it works for you and it stacks up, get on with it and move on to the next one is normally the way forward if you're trying to build a portfolio, or even if you're trying to move house to your own individual permanent private residence, because do you know what? You don't need the headspace. It's an incredibly stressful situation. Admittedly, you've got to make the right decision, but once you've made one, stick with it for goodness sake. Anyway, we continue to have more listings than in any year in the past 8. So this suggests to me some backup in the pipeline, as in people who were wanting to sell and held off last year, a bit like in the early days of COVID. And we've also recovered from the brought forward purchases that were inspired by the stamp duty holiday that was part of the COVID package of measures. Sales agreed in May stand at £350 a foot. April was 344, March and February were 339, January was 331. And if we go back a bit further, December was 329, November was 331, and October was 330. So anyone who's expecting a downwards or even sideways print this year is going to need something bad to happen from a wobble perspective to have any chance of being correct. So bear in mind, this is sales agreed almost in real time. So they are still taking on average 100 plus days to go through the system. That's another 3.5 months before they hit the land reg. So that would take us to sort of end of August. And we don't find out about August land reg figures until October or so. And therefore, that's how far ahead we're effectively able to predict the future by looking closely at these figures. And that's why we do it. But they're going to bear out a 5% or even better marketplace at this rate. That's where we are. But we have got to remember the election and we have got to remember seasonality before we get too excited. This is probably the best part of the year. And when the sun's out, property tends to sell better as well. We've also, though, got to remember inflation, particularly wage inflation, and interest rates about 1% better than they were in 2023 at certain points. And those things are actually helping. Yes, it's expensive compared to 2021 or whatever, but 2021 is a false flag anyway. We shouldn't really be comparing anything to 2021. We've got to go back to before the pandemic. And sometimes back even longer than that, back to the last time the base rate and the rates of interest looked like this. But I remember doing deals in 2014 with 6% interest rates, and do you know what? They stacked up. And do you know what? The market's getting back there as well, because the capital values have been sideways and the rents have been racing forward, which means the yields have been racing forward. And this is a big reversal of what's been going on for nearly 10 years now, as yields have been trending down and down and down and down and down, as capital values outpace rents. We're completely the other way around at the moment. And I think that phenomenon is going to last for quite a while, certainly till after the election. So, is it worrying or is it less worrying? We've got so much backup in this market, so many listings. I think it's good because it shows stability. Now that stability will evaporate, I think, when the election's called, but let's see. But there's one big message I wanted to get across in this section, and that is that buying from the open market should be easier than usual. It's very easy, of course, if you're not worried about your budget, but it should be a little bit easier to get bargains than it has been for quite a while and still have an affordable interest rate. So, onwards. Unlike last week, we only had this one real chunky report of interest, and then it was only scraps really on the macro data. And that one of interest is that ONS labour market overview, and not only containing the unemployment figure, but also some better metrics that don't get as much airtime. The first point of order, though, is that there was a flash estimate in March of 67,000 people having lost their jobs, according to the ONS. The final figure, 5,000. So that's some miss. The April estimate is 85,000 more unemployed. So we don't want flash estimates like that, of course. But in the face of that sort of revision, I think we can safely say the labour market went backwards in April, but not particularly sure that that sort of estimate is anything to hang our hats on. I wonder, as an aside, just how much of that would have been inspired by the minimum wage hike. The employment rate is 74.5. That's my favoured metric. 1.7% below the pandemic, down 0.6 on the quarter. A significant drop. As I said, though, figures are a bit wobbly. Let's see what happens come September. But that would be very congruent with what we heard from the recruiters and other people in real time who were plugged into the job market in Q1. This is what we were hearing. The economically inactive rate, so remember this means you're between 16 and 65 and you're not working, not seeking, effectively. Why not? Well, you might be a long-term student, you might be long-term sick, and sickness is the the big thing that we know that's changed. I've talked about that many times. That 22.1 is 1.6 above where it was before the pandemic. Now, I'm going to end the lesson there because I've spoken about that enough in the past. But the growth of earnings, excluding bonus, which I'm preferring is the best metric at the moment, because COVID-sponsored bonuses were used and have been used frequently, but they skew the base figures, is still 6% for the quarter. No change from December to February's figure of 6%. That led to a real terms increase of 2% when adjusted for CPIH, which includes housing costs, remember, or when adjusted for CPI, it was more like 2.5% upwards in real terms. Vacancies are just under 900,000, but still over 100,000 more than before the pandemic. Drastically different from 1.3 million or so, that's where we were, but still it looks to be evening out. All in all, we knew from real-time reporting and vacancy data, and also from recruiters saying what a tough Q1 they were having, that this was all coming. Vacancies since this period, this is reporting on, which is since Q1 2024, have actually been pretty steady if we trust the ONS real-time data from Adzuna. A touchdown and now back up again. And I did have a message, a very useful message from someone actually after I posted the supplement saying, look, the Adzuna data is not great. A lot of the ONS data is not that great. They're using one company. They do this with Propenomix, for example. They do this with a number of different companies. But similarly, you see a lot of headlines posted from people like the Nationwide who are only using their own data. So it's similarly flawed. But it's a pretty good bellwether, although the messenger has given me a potential source of some better real-time pay data. And there are other sources. You know, the S&P Global have a flash jobs metric, which is pretty good. Their surveys are obviously not just one company. They're going across companies and they get people to participate. And the S&P Global PMIs are the better PMIs in the game. So I may well start incorporating the S&P flash jobs data. But very grateful to anybody who wants to send any messages of potential improvement. Always pleased to try and get better in the integrity of the data aside from anything else. But the point really is things look to be close to be levelling off. And they don't give the appearance of necessarily trending downhill too much anymore. So soon I think we're going to snap this streak off of vacancies going down month on month, maybe even at next figures, because the February to April quarter will drop January's figures, which are always lower. But let's see. So we roughly know where we are. Wages are still pressing things upwards. Next month's figures are surely a penalty kick to be above 6%, because I calculate around 18% of the workforce to be heavily influenced by or pegged to the minimum wage some way or another. And they moved up 9.8% or more in April. That's obviously well above 6%, so it drags things upwards. This isn't a 2% inflation environment just yet, as I seem to be saying quite a lot, and wages are indeed proving very sticky, which economic textbooks would tell you that's exactly what happens in these situations, especially when in this wave of inflation that we had, prices went first, right? Wages went second, and rents went third. And that's why you're going to see more sustained increases in wages and in rents. So, productivity is our next port of call on the back of this. It's been a buzzword for some time. I have a slightly different take to many on the productivity puzzle since 2008, because I believe a lot of the figures leading up to the financial crisis were frankly false. There was fraud that was widespread in the property sector at the very least, and then I don't believe the data has fantastic integrity from 2006 to 2007. If you rebased a lot of that post-2003 activity as it really started to heat up, you might have a different take on the productivity puzzle. Now, obviously, I'm projecting what I know about property into the broader economy, but 2007 is not a good bellwether of a year to hang our hats on because there was just too much fake activity going on in the economy. But, of course, the pandemic seriously hurt productivity. Inflation doesn't help. Sickness really doesn't help. Minimum wage rises that are seriously impactful also won't help. Productivity and preliminary estimates for Q1 2024, though, are 1.7 and 1.5% up when looking at output per hour and output per worker when compared to the 2019 average level. So we have improved productivity over the pandemic period, but of course over a 5-year period, that's not that impressive, but much better than the figures in the public sector, which I discussed last week. So, over onto the gilts then. We got under that magic 4% barrier when US figures, when revised, looked a bit better for inflation on that side of the pond. Many are still saying inflation is over. For me, the US figures don't indicate that just yet. Still, growth has faltered, and that looks like a very good excuse to try a rate cut over there to me. The UK doesn't have that problem or opportunity, depending on how you look at it. When the US yields dropped, so did ours, and we tested that 3.95 barrier again. But again, Friday's trading took us just above 4% at the close. 4.015%, frustratingly. We had some more really boring days where we stayed between 0.05% between the high and the low on the yields, reminiscent of the old days of bond trading. Happiness is a boring bond market. As long as the trend is downwards slowly, we'd all take it. We opened the week at 4.019, which was lower than the close of the week before. Did a bit of a dance, tested that 4.1 after the unemployment figures, tested that 3.95 after those US figures, before we closed almost exactly where we opened on the week. Next time, gadget. Thursday closed at 3.975 on the 5-year gilt, and the swaps closed at 3.881. The discount I've been referring to for months now is being preserved. There's more supply of money for the 5-year fixes than there is demand right now, and if anything, that discount has increased by a couple of basis points. Just as a small aside, this last week was a fairly limp week at auction from what I saw. There were post-auction deals to be done, good enough to warrant a mention here. I would love to speculate that the reason was that the rates have recently gone up again and that these newer yields haven't really fed through into pricing just yet. They have a little on the high street, but not in the buy-to-let sector. It's more than likely a fluke, although this was our best week of trading of the year so far, which was nice. Bargains were snagged and snapped up for happy buyers. So, just a roundup of the Bank of England influencers to go before I get stuck into the report on the quarterly live briefing. First up was Hugh Pill, the chief economist. Not an official speech, but plenty of press coverage. When I say official speech, I mean something which is published by the bank. But Hugh Pill did speak to the press, and of course he puts a lot of thought, and so does, I'm sure, the rest of the bank in terms of the influence they have on him, in terms of what he's going to say to the public, because what he says will move markets, if it's the right or wrong thing to say. There were lots and lots of press coverage on the subject, but the most balanced articles pulled out two critical pieces of language. Summer interest rate cuts described as not unreasonable, but with still some work to do. And that's a pretty good summary, and I wouldn't disagree with it strongly. I think they're less likely than that makes them sound, the cuts, but it depends when you end summer, of course. Mr. Pill also referred to a labour market which is still tight, which it is. Then we had the official speeches. First up was Megan Green, who I make no secret is the member of the MPC that I most identify and agree with. She was keen to point out there's been labour hoarding going on, a very UK phenomenon. She's from the States, so we do need to be careful not to be typecast here. But it makes sense with very low levels of unemployment. Who can you get to replace people? And also, wages remaining high in spite of waning inflation because of this labour hoarding. So sometimes this means the same number being employed, but fewer hours per head. The bank sees the equilibrium rate of unemployment now, the steady state rate, as about 4.5%. Ms. Green showed how economic models haven't worked that well since the pandemic and furlough, because there's obviously been other forces at play. Lots of gradients have changed, lots of the relationships in the way that inflation and unemployment, wage inflation and unemployment work together or move in an opposite direction from each other. Those correlations have changed fairly significantly. The bank also sees wage inflation staying well above average for more than another year at this time. That's not the sort of chat that gets central bankers to cut rates, in my opinion. I think the most parish is in sharing Ms. Green's last two sentences in their entirety. I think there remains more uncertainty about how much inflation persistence indeed persists than there is about our monetary policy stance is weighing on growth. In considering for how long we must retain our restrictive stance before policy should be eased, I think the burden of proof, therefore, needs to lie in inflation persistence continuing to wane. So, how persistent is inflation? How much does it stay in the system? We see this through core inflation, but we can see this through services inflation. We can see this through wage inflation, both of which are still at 6% and are going down very, very slowly at the moment. However, her statement's not incredibly strong and hawkish. Inflation persistence should continue to wane. It will be slow, and she doesn't say anything about the pace and whether that worries her or not. But if you trusted the Bank of England models, and you shouldn't at all, but if you did, then 1.6% inflation at the end of our 3-year forecast is likely low enough for a cut. Depends what you think of what the markets think about the path of interest rates, and there isn't major disagreement on that subject at the moment. So Megan's not a never cutter at this stage. On to the other speech on Friday, which was the reason why I thought on Friday morning bond yields might move upwards a bit. but that wasn't really the subject of the talk. The hawkiest member of the committee, Catherine Mann, also spoke. She was speaking about UK business investment. Investment since the financial crisis has been really poor. That's a fair spoiler alert. Those who know that buybacks have been a much more popular way for companies to invest in the past 15 years or so. Investment is sensitive to the interest rate, particularly for firms investing using a hurdle rate. This rate has moved upwards in recent years, simply because the base rate is up so much. The hurdle rate is, remember, the lowest rate that an investment can return to become viable. So it's got to hurdle over that rate in order for the investment to be a go. And all businesses would rather clear the hurdles in style, of course, rather than brush across the top of them. She concluded that large firms perform well, mega caps have lower hurdle rates, but more capital allocation problems and a lower cost of capital too. And it scared me a bit to learn that 50% of UK investment is undertaken by 0.5% of large multinationals. What a dependency that is. And perhaps that gives a little bit of context to George and Dave, Chancellor and Prime Minister back in 2015, and to why they cozied up to those multinationals quite so much. But ultimately, consumption is the driving force in the economy. Whilst we need investment, we've done very poorly on investment since the financial crisis as a country. So whatever they did, even though that was their strategy, cozying up to the large multinationals, it seems they did it more to get themselves pretty good jobs afterwards rather than to really help the economy. But there you go. So enough of the macro, even with the bonus sides. We need to move on to the Bank of England briefing. For those who haven't read or heard me talking about these before, the bank sends their regional representatives out to interact with and inform the local business community. They provide a presentation, take questions in good humour, and they're there to spread the word as well as take the temperature. So our West Midlands regional rep is quite likely sick of the sight of me by now. I'm a guaranteed question, and as time goes on, I'm at least 2 questions. One in front of the room, and one where I'd rather get an offline opinion because the rep can speak more freely. These days I also have to quell the urge to explain a concept to one of the other questioners who either seem to have an agenda, a strong feeling, or misunderstand one of the chief points of the presentation. This time round wasn't much difference. Anyway, I went through the executive summary of the report last week if you didn't catch it. This concept of bringing down rates soonish when it's right to do so isn't a fat lot of help, let's face it. The bank has also, in case you missed it, taken a bit of a pasting because their forecasts have been rubbish over the past few years. I often refer back to inflation, and when I first started talking about it, which was Feb 2021, in this cycle. It was late Feb, don't worry, after I started talking about it, when Andy Haldane, who was the chief economist of the bank at the time, made a speech about just how wide the inflation path might be. I like Haldane a lot. He's a very sensible and pragmatic economist. But he is but one person who could not, when he was in the post that he was in as chief economist, speak particularly freely. He did in that speech say this: thereafter, the MPC foresees UK inflation remaining around its target level. The risks around this projection are, in the MPC's judgment, large but balanced. That these risks are large is fully justified by the high degrees of uncertainty that exist around the forces driving inflation in future. But given likely trends in these factors, my judgment is that the risks to inflation in the UK are skewed to the upside rather than being balanced. Certainly there are good grounds for believing future inflation may behave very differently than in the past. My judgment is that we might see a sharper and more sustained rise in UK inflation than expected, potentially overshooting its target for a more sustained period as resurgent demand bumps up against constrained supply. So, really interesting, because when you get through the political side of that quote, what he's saying is, I don't agree with what the committee have decided is the party line. I think inflation is going up and it's going to spend a long time above target. And Andy, didn't it ever come to pass? A very good shout from you. So let it not be said that the Bank of England weren't told about this or didn't see it coming. They just decided and disagreed enough with the chief economist, and to their detriment and the detriment of the people, ultimately, because interest rates could have started coming up faster, or earlier at least. They might have reached a less strong level and things might have been much more orderly. Although I'm sure if Liz Truss has still been elected, there still would have been a big problem. Anyway, that's nearly as strong as I was about the whole thing at the time, bearing in mind he was constrained, as I've said. And he was right. So he was keen to discuss the probability of rates going up, even though it was also Feb 21, when that speech was from, when the Bank of England asked commercial banks to take a look at what would happen if the base rate had to be lowered to 0 or below. Haldane was on the excellent The Rest is Money podcast with Robert Peston for a couple of episodes recently, and could speak more freely now, of course, because he's no longer the chief economist. Hugh Pill is, and they're worth a listen. One of his legitimate concerns was that the spending of savings from the pandemic, when unlocking, finally did come. And there was a bit of that, although at this point, that consumption boom has been and gone, and spending is quite a bit lower than even 1 year ago. Particularly in the 55 plus age bracket, who are discovering once again that saving can actually pay. Even if it only pays 5% or so if you shop around. That's 5% compared to 1% maybe if you were lucky 2 or 3 years ago. He also chats about how bad the bank has been at forecasting. This was featured in last week's supplement because they were even bad at predicting GDP in the now. Indeed, this was my subject of my question to the bank's rep in front of the room. Given that GDP in the bank's eyes was forecast to be 0.2 in Q2 2024, and we're halfway through that quarter, and we had a 0.6% print when the bank expected 0.4, and NISA, the National Institute of Economic and Social Research, are predicting 0.6 for Q2, which looks more correct to me. Does that significant change make it more or less likely that we are cutting rates in the near future? Now, I know it's a funny question in a way because I know the answer. The bank says that they expect GDP growth of 0.5% over the next 12 months. That's very obviously wrong at this stage as an expectation, because if we're looking at 0.6 this quarter, then unless there are reasons for another technical recession, which there aren't, how can 0.5 be in any way a good forecast for the next 12 months? It's patently wrong. The rep confirmed that indeed if we have 0.6% growth in Q2 or anything like it, the case for cutting rates is significantly weaker. However, he did point out that, as I highlighted last week, the path for inflation expected if the base rate moves as the market expects, and that's 2 cuts within the next 12 months, 6 cuts within the next 3 years at the moment, current market expectations, then the bank's forecast is inflation at 1.6 in 3 years' time. That implies there's room for more cuts than that, but it doesn't bake in the fact that we're growing at 2.5% annualised at the moment. That will surprise everyone apart from Sunak and Hunt, who will claim credit for this part, of course. I think it's even simpler than that. The economy's actually done really well apart from inflation. Growth is pretty much the only metric that has inflation baked into it by definition. None of the others do. We did incredibly well between Q4 22 and Q4 23 not to have a massively shrinking economy because the inflation over that time period was 7% on average. So the figures needed to grow by more than 7% to be adjusted downwards by 7.2% and show a shrinkage of 0.2. Still pretty impressive. Now, that's also a bit of a false dawn because the population grew and so per head performance was worse than that. But not terribly worse given the inflation constraint. Regular readers and listeners know that I prefer per household to per head for our purposes as property investors because heads don't rent property, households do. So, the bank's models aren't just rubbish over 3 years, they're rubbish right now, in the near future. This growth spurt has taken them by surprise. As and when it does start to wane, and it does because the path is never smooth, then I'll be reporting on it in real time. But as I speak now, there are no clear signs of when a wobble is coming here. So my offline question for this quarter to the rep whilst on that subject was, why don't the government in the UK as well as the US consider raising the inflation target? Now remember, it's the government that sets the inflation target for the Bank of England. I couch this with some of the research I've done on pandemics and that inflation tended to be a problem for decades afterwards, historically. 3% makes much more sense than 2% at the moment as a target. That is my argument. He had a couple of interesting points on that one. Firstly, of course, it is a government decision, not a Bank of England one, but he accepted that the influence of the bank at governmental level would be a key factor. Secondly, he pointed out it's also a credibility issue. You'd have to be sure before you change the target, because if you changed it back down again relatively quickly, you'd start international markets wondering if you knew what you were doing. And we don't want that, because we don't want another lettuce gate. That makes sense. On reflection as well, there would have to be a reaction. How would bond investors feel? Well, rate expectations would actually be cut, almost certainly. It would save the government and thus the people tens of billions, if not hundreds of billions, because lending would become cheaper. Why? Because the markets would know that if inflation is not only going to be allowed but encouraged to be 3% or no, then rates will be lower, because inflation can be higher than the target that has been set for the past 25 years. I see a much stronger argument for doing this than against it. I'd be even stronger about this than stopping our stupid quantitative tightening programme, which has a £45+ billion bill attached to it, which I'm furious about, because this would, I think, save us more than 45 billion. I also think the headlines about this would be tiny, because only 100 people or so are going to actually understand it, just like LDI, LLDI, CDOs, MBSs, and all of those lovely acronyms that only get explained to us laymen after the event. Bond traders would have a field day, and equilibrium would be disturbed in a way that would favour the people over the hedge funds. Yum. As you can probably tell, I'd be a nightmare in policy departments, because I'm sure I've missed something here, but I'm convinced that I'm right. I'm also trying to do the best thing for the country, not for myself, which I'm sure is the common thread across all policy departments, naturally. Mostly. Sometimes. Alright, sometimes there are conflicts of interest. Anyway, those were my questions. One other question was asked about inflation. The rep tried to explain that we know inflation is coming down to 2% in the print that's coming this week. I disagree it's going to hit 2, but we'll see. My latest data was at 2.4 because the economy is hotter than expected. But this isn't hot growth at the moment because it's in the business sector and services side rather than the consumption side. So we also, in theory, have a major disturbance to GDP baked into the figures from 2025 onwards because of the austerity that has already been decided by Jeremy Hunt. And it will be hard for Labour to depart from it because remember, GDP is consumption plus investment from businesses plus government spending plus net exports versus imports. So investment does look pretty promising now. The Money and Credit report for March was pretty positive with the highest net borrowing for a couple of years by businesses. That money, as I said at the time, goes into investments that stack up even at today's interest rate. That all fed into the growth figures, of course. Hence, growth looks good in the near term. But as I often say, you can't tell anything by 1 month, so let's not get overexcited. The questioner was asking why, if we were going to hit 2%, we couldn't cut rates. The rep was patient and explained that inflation is forecast to go back up. And that's a guarantee at the moment because energy prices aren't coming down anymore. The last sweep on the price cap forecasting by Cornwall Insight that's in the public domain, they tend to be the best at predicting it, is now a couple of months old. And system prices are up a few pence on then. So if we do see a reduction in July on the prices, it looks like it will be, as at today, less of a reduction than they forecast back at the end of March. We'll know about the cap by the end of next month. Still, the model, already lambasted for its lack of accuracy, does have inflation at 1.6 at the end of the period, which is below the target. It has the wrong growth path calculated into it. For clarity, they've said 0.5% over the next 12, then 1, then 1.25. You can tell they're guessing a fair bit because it's to the nearest 0.25%. And they have to, of course, because there's so many factors at play. However, I see no evidence of the currently best performing economy in the G7 by growth, nor the tightening in government spending baked into those figures. I'm expecting much better for 2024 now. Under 1.5 at this point would be a disappointment, but challenges after the election for the next administration. So, what else came from the presentation that I'd like you to know about? Services inflation was mentioned again to a reasonable degree, as was my point that wage inflation at 6%, expected now by businesses to be at 5.5% on average throughout 2024, up from 5% last quarter's meeting, which was businesses' expectations. So they've moved up about 0.5% in their expectations. Neither of these are a 2% inflation environment, as was mentioned already. Neither are trending downwards particularly quickly either. However, the point that wages are still catching up, which is fair, as goods prices move much more quickly, and therefore aren't necessarily anywhere near as inflationary as they would otherwise be, is one that was well made, and one that I accept. It's the overall stickiness of this, as I've said. There's no way the employees as a whole put their hands up one day and say, actually, we've had enough now, so there's no need for these pay rises. These rises benchmark each other on an ongoing basis. So whilst that's economically true, I'd rather focus on what the likely behaviour will be in the real world. The current minimum wage forecast for 2024-25 is 3.9% up as a midpoint, but up to 6.5% with a low of 1.8. I can tell you now that the data input into that forecast was wrong and underestimated the current level of pay rises not at minimum. The number comes in September, but next year will look more like £12 or similar for the minimum wage, in my opinion. Labour may also push minimum wage up even more and make it yet closer to the median wage. That's what's been done quite aggressively in 2020 and 2024. The current target is 2/3 of the median wage, but the next step could easily be to get it to 70%, then 75%, then 80%. We don't know, and we will see. Services inflation is now 49% of CPI, up from 47%, and was 6% at the last print. That on its own still provides us with a starting point for CPI at 3%. Core inflation wasn't even mentioned at the meeting this week, but will still be over 3% in next week's print. And as I keep saying, April's wage figures aren't out yet, but there's a spike coming that will last for April, May and June because they're reported 3 monthly because of that minimum wage increase. In the medium term, there was an overall tweak to the figures which definitely pricked up my property radar. The ONS have revised population estimates, and at this time the expectation is the population at age 16 plus increases by around 1% a year, rather than 0.75% per year, which was the old forecast. What's the quantum of that difference? Well, it's about 170,000 people a year. Where's that coming from? Migration. What does that mean? Around 150,000 or more new renters per year. These are huge numbers. These are the relevant opening paragraphs from the ONS report. We'll get another update in the final quarter of this year, but suffice to say, those who watch migration numbers far more closely than I are convinced that the ONS projection of 315,000 net migrants per year is too low. They think 400,000 plus is nailed on. I would take a slightly more balanced view from what I've read and say I think probably the number is 350 to 375 at the moment as our best guess. But let's see. Over the 15 years between mid-2021 and mid-2036, according to the ONS, the UK population is projected to grow by 6.6 million people, which is just under 10%, from an estimated 67 million to 73.7 million. This includes 541,000 more births than deaths, and net international migration of 6.1 million people. And those who are eagle-eared there will hear, or eagle-eyed, that one of the things that annoys me about the ONS, 67 million to 73.7 million is actually 6.7 million, not 6.6 million, as they've said. But anyway, there we go. The UK population is projected to reach 70 million by mid-2026. This growth is faster than in the 2020-based projections released in January 23, with the projected increase mainly resulting from international migration. The population projections for the UK are based on an assumption of long-term net international migration of 315,000 per year from year ending mid-2028 onwards. This is based on expert views and the latest data covering the last 10 years. Now, I should just say about these expert views, this is the 4th or 5th time in recent years these have been revised upwards. So I'm not sure these expert views are quite so expert because they've been very slow to react to what they've been seeing in real time. But there's always some uncertainty in migration estimates, where the actual levels of future migration and resulting population might be higher or lower than assumed in these projections. Of course, a forecast, by definition, when it's released, is inherently wrong. I hate that attitude, to be honest with you. I hear it all the time these days. I think you should just try pretty hard to make sure your forecasts are pretty accurate. Of course, it's difficult to get things spot on. But anyway, having looked at the trends myself and made some COVID allowances, and also allowances for more restrictive policy, look, 400 is more likely than 315. And as I've said, 350 plus average I see as pretty much nailed on. Regardless of who wins the election in the current iteration of these parties, of course I'm ruling out the Reform Party there because they want to completely restrict, put a cap on and say no more as far as immigration goes. Anyway, as an aside, if you're ever thinking about getting into elderly care, by the way, there will be an increasing number of older people. Over the next 15 years, the size of the UK population aged 85 years and over is projected to increase from 1.6 million, 2.5% of the total population, to 2.6 million, which will be 3.5%. An incredible difference. So the future supply of tenants looks very secure indeed, folks. We will look back on pre-pandemic as if there were no issues at all in the UK housing market. Mark my words. That will be wrong, of course, but this shift over the coming 10 to 15 years will be like nothing we've ever seen before. Back to the report. The bank has defended its poor forecasting record by pointing out how much external data they use, and it's that data that's been wrong. That's backfired a bit, and I did say some time back that the least surprising thing ever would be Ben Bernanke, US central banking legend of sorts, recommending we do things a little more like the US. The best manifestation of that would be a dot plot, where instead of hiding behind what the market says about the interest rate, the bank's committee members all plot on a very simple chart where they think the interest rate will be in 3 months, 6 months, 12 months, 2 years, longer term, etc. I agree. They absolutely should do this because for a long time during this hiking cycle, we were constantly told the markets have got it wrong, and at points they did get it wrong. especially when they saw rates above 6% for base around the mini-budget time. But if the markets are wrong, let's see how far wrong the bank thinks they are. Let's have more room for the bank to overrule them and the models that have performed so badly in the past few years. One other aside that I need to shoehorn in here in simple terms. Wage, benefits and other income rises at the moment are being saved. They're not being consumed. This isn't very inflationary at all. Indeed, it's somewhat disinflationary. Why? Well, worries about geopolitical concerns, worries about changes of government, the 7% of households with children that attend private schools. Do you think they're consuming devil-may-care at the moment? Or do you think they might be building war chests to pay those fees? And that's one very specific example, but there will be others. More attractive savings rates, as I already said. The savings ratio is double what it was before the pandemic, whatever the reason, and it's trending upwards. That's good for inflation, but bad for the growth of companies. They pay out more, but it doesn't get spent on their products or services, as a simple analogy. However, as I've said, the vacancy shedding that's been there for the past couple of years now looks nearly over to me, looking on the real-term figures. There's no guarantee in a lot of these trends, of course. If there were, forecasting would be easy. There were so many charts I could have used from the report this week, but one really caught my eye at the presentation. And if you take a look at the supplement on my LinkedIn, Adam Lawrence, Propenomix founder, you will see what I'm trying to point out here. It basically plots households' expectations of inflation, businesses' expectations, and financial markets' expectations. Now, typically, it doesn't map all of those particularly far back, but households it does. And do you know what? The households have done a pretty good job over the past 15 years or so. And do you know what else? Their expectations been about 3%. So isn't that incredible when you compare the financial markets expectations, which has been very poor? The expectation has basically been what's the government target, which has been utter nonsense. So businesses have done a pretty reasonable job. Households have done a better job. If you mapped households and businesses together, you'd find it was really quite accurate indeed. Unfortunately, what's missing from the chart is the actual rate of inflation. And I don't know why the bank have left that off. And I'm a little bit suspicious as to the person who puts the chart together, to be honest with you. But I wanted to share it to show you how household expectations, unless there's a black swan, are pretty good. And where are household expectations for inflation right now? About 3.5%. Tells you what you need to know, in my opinion. But anyway, they were ahead of the game. They expected 10%. They actually got 11 in the end, if you remember. And that was only held at 11 thanks to the energy price cap. But there we go. So medium term, households expect 3.5. Businesses look like about 2 3/4. Yeah, almost as if they agree with me that moving to that 3% target would be a good thing. And if they found out that that would mean interest rates would go down, oh boy, they'd definitely be on board with that. But yeah, those expectations were there for what was the inflation rate in 2010 to 2019? It was 2.7% on average, and households have been predicting about 3%. Not bad, households, not bad. So, what can we conclude, and how does all of that help us? Well, cuts are more expected than they are realistic, in my view. We'll be waiting a while for anyone to do anything sensible, such as change the inflation target, so we better just get used to these swap rates around 4% or so. I do still expect these to fall back by another 1/4 to 0.5% as the year goes on, but we might be waiting till Q4 for that. Rental demand, well, it's going to continue to skyrocket. Expect rent increases at or above wage increases for some years to come. The future on that side looks incredibly dim for tenants and strengthens the investment case quite a lot. Remember, this isn't the only fruit. What will compliance look like? What will changes in tenants' rights look like? There's still plenty to put people off. Labour aren't going to be kinder than the Tories to landlords. That would be so forward-thinking as to be impossible. Too ideological, usually. The housing market is going to get more and more broken. Wages are going to stay sticky for some time, and the current gentle upward trend in the housing market will continue until at least the election is announced, and the market might just be a little bit more robust than usual. But everyone hates uncertainty. That bit will never change. Inflation, you're smarter to expect around 3% than 2% in the near future, in my view. Next week, the release this week, notwithstanding. But don't just expect to cut because we hit target, even if we don't. Expect the dead cat bounce, which might take a quarter or so to kick in, but could be quite fast. Pending shocks, the economy is doing okay, and on a personal and business level, I think it's a great time to be investing. Growing markets, pathetic supply of housing, Lots of opportunity. Let's see what happens to the savings versus consumption angle. But the market feels ripe for purchasing right now in the face of the fact that prices are, in spite of many predictions, simply going up again. Remember, almost everyone got it wrong because they didn't understand inflation. It's still with us and it will be for another couple of years yet, but the effect might not be massive. Regardless, I'll be there by your side with humongous reports in great levels of detail, trying to cover all angles in my army of one. Well done for getting to the end of this one, 45 minutes long. Remember those super early bird tickets for the next Property Business Workshop, Thursday the 4th of July, bit.ly/PBWTHREE. There's only one way to deal with all of this continual noise, of course. Keep calm, always listen or watch the supplement, and carry on. Thanks.